Chancellor, Governor, Ministers, ladies and gentlemen, good morning and welcome to this slightly reformatted financial and professional services breakfast event. I'm delighted to be able to welcome the Chancellor of the Exchequer and the Governor of the Bank of England here to Mansion House. Governor, it's good to welcome you back in person, and thanks to you and your team for all the work you have done to keep our financial system stable during the ups and downs of the pandemic. And Chancellor, it's great to be able to welcome you here to give your first Mansion House speech. No one should underestimate the scale of the challenge you faced so soon after taking office as Chancellor last year, dealing with a truly unprecedented shock to the UK economy. What a first year you had, genuinely a baptism of fire. We all look forward to hearing you build on the vision for UK financial and professional services that you set out last year, and how we can work together to achieve this. The signs so far for city competitiveness have been encouraging. We welcome the listings review by Lord Hill to attract more IPOs to the UK and boost our capital markets. We were very pleased to support the Khalifa review into UK fintech, with its recommendations to help turbocharge this vibrant sector and maintain access to the global talent that is so essential for its success. In fact, one thing that comes through whoever I talk to is that one of the foundations of the city's success is that it is a magnet for global talent. 40% of the city's workforce comes from overseas, including 40% of those in the city's financial service firms. So we strongly support the new global talent visa, and we want to ensure that as a country, we do all we can to continue to welcome global talent, while of course building up on our own domestic skills base. As well as the City of London's chain of academies, this is an area we will also be working on through the new task force on socio-economic diversity in UK FPS, led by my colleague Catherine McGuinness, our Chair of Policy and Resources. With the City of London Police's role as national lead force for economic crime and a leading specialist force for protective security, we will continue to ensure the city is one of the safest and most secure business districts in the world. Yet another reason why international firms choose to locate here. All of these measures to boost the competitiveness of the city are essential as the UK adjusts to our new position outside the European Union, where we must do all we can to compete in the global marketplace and continue to always show our openness to the world. This is the aim of my theme as Lord Mayor, Global UK, the new future. As we look to that new future, the UK's position as a centre of global finance will remain one of our strongest cards and a key part of our offer. While we cannot be complacent, London remains the world's leading, most innovative and most connected global financial centre. The first major poll of international investors since the pandemic shows that 99% are still keen to invest in London. And I can assure all of you, we are working on the other 1%. Financial and related professional services account for 10% of the UK's GDP and more than 13% of the total tax take. Financial and related professional services together employ over 2.3 million people in the UK, and 2/3 of these jobs are outside London. As Oliver Shah put it in the Sunday Times recently, the capital may be the heart, but it pumps blood to vital organs in Edinburgh, Leeds, Manchester, Birmingham, Bristol, and elsewhere. In recognition of this, the City of London Corporation has been working more and more closely with these partner cities across the UK, along with Belfast, Glasgow, and Cardiff. As Lord Mayor, it is part of my role to travel across the country and also to include firms from other cities on my overseas trade visits, ensuring that we speak for the whole UK financial and professional services sector, a sector which supports jobs, growth and investment across the whole nation, whether it be Richmond upon Thames or Richmond in Yorkshire. I have said before that we have no need to try to be Singapore on Thames. London is the UK on Thames, which draws on the strengths of the whole country, which works for the whole country. And UK financial and professional services, with their global reach, their resources, and their capacity for innovation, must be the very heart of our efforts to build back better from the pandemic. Of course, building back better has become a global catchphrase, being adopted by the leaders of the G7. There is a worldwide recognition that we have to act now, act globally, act radically to deal with the challenge of climate change. The UK is leading the way, and our financial services must not only lead the way as well, but help the whole world make the transition to net zero by greening finance and financing green. London is becoming one of the world's leading centres for green finance. For this, we have to thank the leadership and foresight of my dear friend Sir Roger Gifford, who died just over a month ago. He was a pioneer for sustainable finance, chairing the Green Finance Initiative and then the Green Finance Institute and heading the government's Green Finance Task Force. Sir Roger saw clearly the crucial role which finance had to play in tackling climate change, and his leadership ensured that others saw it too. Chancellor, we welcomed the commitments you made at the Green Horizon Summit last year on mandatory TCFD disclosures and a new green taxonomy, alongside the launch of the UK's sovereign green bond. This year at COP26, we need to see the global commitments to finance the transition to net zero. We are supporting Mark Carney in promoting the private finance agenda for COP, and will be running a Green Horizon Summit at COP26 to bring together sustainable finance stakeholders from across the world and mobilize private finance for net zero. The eyes of the world will be upon us. Humanity expects us to do our duty, and today we are launching a new report underlying how critical UK financial services will be. It is called Championing Sustainable Finance, the UK's global offer. It reaffirms that UK investors and asset managers have the expertise and the aspiration to invest in green, with green investment projects set to grow. The UK also houses the full suite of top-notch professional services to support sustainable finance, with the Global Green Finance Index ranking London as top in the world for quality of professional services and knowledge. And crucially, the UK government and regulators are creating the conditions and setting the right standards for sustainability. The UK, therefore, has all the ingredients to be the go-to location for green finance. Crossing borders and sectors, UK financial services are ready to mobilize and scale up sustainable finance across the world, driving the transition to a greener future. Chancellor, the UK's financial and professional services have risen to the challenges of the last few years and continue to open doors for the UK around the world. We will work with you to make the UK as competitive as possible. We will work with you to support the recovery from the pandemic and build back better. And we will work with you to mobilize finance for net zero and grow back greener. Thank you. Now it is my pleasure to introduce the Governor of the Bank of England, Andrew Bailey.
Well, Lord Mayor, thank you for those very kind words of introduction, actually very important words of introduction. And Also, can I underline your recognition of the memory of Roger Gifford and the important role that he played? There's been nothing unusual about the last 16 months, really. Even long-standing neighbours like the Bank of England and the Mansion House have had to resort to video conferences rather than popping around for a word. And one of the trickiest issues, and I think we've all faced, is dress code and etiquette. Is this a ties-on video or ties-off video? Who knows? I can only tell you that I'm about the worst predictor of it you can ever wish to come across. But I have to tell you that the Lord Mayor threw me some months ago, actually, when we were doing a joint event, speaking at an event, and we had a video call about an hour beforehand, and the Lord Mayor was dressed in a bomber jacket on this video, and I was pretty thrown by this because I thought, well, white tie to black tie to bomber jacket, where are we going here? All I can say is that by the time we actually did the event, the Lord Mayor was very respectable and true to tradition, although he wasn't in white tie, I should tell you. Well, usual or conventional is not a word that I've used about the performance of the economy in the last 16 months. The good news is that the economy is only around 5% smaller now than it was 18 months ago, and the gap is closing quite rapidly. But of course, in any conventional time, saying that the economy is only 5% smaller than it was back at the end of 2019 would scarcely qualify as good news. We'd all be pretty worried, in fact. In a typical recession, to the extent that there is such a thing, there is a hit to demand relative to supply capacity of the economy, creates what we call an output gap, higher unemployment and weaker inflation. And of course, during the COVID crisis last year, we saw a simultaneous and substantial fall, but actually in both demand and supply. Now, all the indications are, though, that decline in both demand and supply will be temporary. And of course, we're already seeing that change, as I said. Moreover, the evidence here and in other countries indicates that the economic impact of COVID has attenuated over time with each successive wave. The economic policy response has been designed to ensure that the longer-term damage will be as small as it can be. And this has involved both monetary policy and fiscal policy pursuing their own independent objectives in a consistent and complementary manner. So we find ourselves now in a situation where there is an output gap, or slack as it's sometimes called, but it's nowhere near as large as it would be implied if this was a normal recession. So I want to talk this morning in the next part of what I'm going to say about what comes next, and in terms of two big questions. The first one is that as we experience a very rapid bounce back, what conclusions can we draw on the temporary nature of the causes of higher inflation? The second one, which is equally important but doesn't get as much attention at the moment, is when the bounce back is done, what sort of economy are we likely to be in? Because that's very important as we go forwards. Now, this process of normalization is very dependent on how these two big moving parts of demand, supply and demand respond, whether they recover in sync or whether they recover slightly out of sync. Where the recovery in demand outstrips the recovery in supply, it's entirely possible that we will witness temporary periods of excess demand, bottlenecks, because that's, in a sense, a reflection of the uneven nature of the recovery. Now, in a normal recovery, signs that cost pressures were increasing and firms were experiencing capacity constraints would be a very clear warning signal that demand was returning close to potential supply. But it's not necessarily the case now, because, as I said, we expect both demand and supply to continue to recover towards their pre-pandemic levels. Now, consistent with that, we're seeing rebounds and normalization of some commodity prices. And there are plenty of stories of supply chain constraints on commodities and transport bottlenecks. But much of this should be temporary. There are shortages of some products, semiconductors, some agricultural commodities, and some end-user products. Now, many of the factors behind these constraints are global in nature, reflecting shortages of products, transport capacity, and all that set against the strength of the recovery to date and the expectations of strong future growth as the recovery continues back to where we were before. So here, consumer price inflation rose to 2.1% in May, which is just above the target, and it's above where we thought it would be when we did the Bank of England forecast in May. Goods prices were strong, while consumer food prices actually ticked down slightly, and the pattern of prices in the services sector was very mixed. But there are within that very different patterns going on. This is not an even recovery in that sense. To give you one example, hairdressing and personal grooming inflation was strong. Annual rate of 8%, a 29-year high. Now you can put that down to pent-up demand, essential need, we can all probably recognize that, or you can put it down to recreating the early 1990s David Beckham look. I leave you to judge that. Further up the supply chain, we've seen higher food input prices. We've seen producer price input inflation at around a 10-year high. But again, it's not a universal pattern. And just for a bit of balance, I can tell you that Victoria Beckham is reducing the average selling price of her dresses by 40%. So it's not at all even in the economy at the moment. So why do we think that these effects could be temporary, this increase in inflation? Well, let me give you 3 reasons. First, there are what we tend to call annual inflation base effects, which were caused by very weak activity in prices this time last year, which, because they're annual, and as a matter of arithmetic, don't last beyond a year. But while they are there, they push up inflation. Second, and going beyond that, we can see, as I've just said, additional price pressures from various shortages caused by this temporary imbalances in the recovery of supply and demand, sometimes as demand recovers more rapidly than supply in some parts of the economy. But again, there's good reasons to think this won't last. Thirdly, we think and expect that there will be a switch from goods towards services as the restrictions are lifted, because the restrictions have had more effect on some parts of the services sector. So again, that should lead to a rebalancing of the composition of demand and the composition of the economy. And over time, if that rebalancing takes place, it should lead to an easing of inflation as spending is redirected towards sectors with more spare capacity. But again, initially that rebalancing may not be even. Where supply returns more slowly than the initial surge in demand, it would be reasonable to think there would be some temporary rise in prices. Let me now turn to the labour market, which of course is also a very important part of this story. And again, it's been far from normal. During the COVID period, employment has fallen much more than the rise in unemployment. 2 things help to explain this. First, the Chancellor's furlough scheme has worked very well to preserve jobs in firms and sectors that have been hit by the effects of the pandemic and the associated restrictions. Second, there's been a rise in inactivity. In other words, those who do not have a job and are currently not searching for one, which again is not surprising necessarily in a context of a pandemic. So if we put all of this together, what are the risks to the outlook for inflation? What must we watch very carefully? Because we clearly do and must watch it very carefully. Well, so far we've seen a pickup in import prices, which has extended beyond energy, and we've observed these increases pass through into producer output prices, so in a sense up the pricing chain, if you like. And to some degree, in some parts of consumer prices, they're now feeding through into consumer prices. In some cases, they reflect prices returning to pre-COVID levels. That's the base effects again. Part, they also reflect bottlenecks in supply chains, as I mentioned, reflecting this rapid but uneven recovery. But there are good reasons to interpret this as a temporary feature. And we must be on the lookout, though, for the risk that of course, these features are more sustained. We can't just assume it's temporary. We have to keep examining it. Second thing is that we could see demand pressures on either side of the most likely outcome. They could be weaker, they could be stronger. They could be weaker if COVID continues to be a material health concern and prompts more caution in activity and spending habits. But on the other side, there's an upside risk. There has been a substantial build-up of excess savings in this country in the last year or so, and that raises consumer spending to a larger degree than would have been true in a more normal time. And frankly, there is a lot of uncertainty because this is not a situation we've been in before as to exactly how that spending out of excess savings, unanticipated savings, is going to play out. We don't know, really. Third, we could also see wage pressures arising if the number of people in work or seeking work does not return to pre-COVID levels and inactivity remains at a higher level. So a return of the labour supply is important as part of this recovery. Fourth, a further challenge would arise if these temporary price pressures have a more persistent impact on medium-term inflation expectations, shifting them to a higher level which is not consistent with the target for inflation. Now, the Monetary Policy Committee judges that UK inflation expectations currently are well anchored. They continue to be so. But it will be important to continue to monitor closely movements in measures of medium-term expectations of inflation, and of course to adjust policy accordingly as appropriate. So let me finish with the second question, which will shape the performance of the economy. What are we going to return to? I've described the bounce back of the economy from the COVID shock, but that doesn't tell us whether the experience of the last year or so points to a change in the underlying economic fundamentals that existed before COVID. But this is a key question in judging the path of growth after this year, whether inflation will be transitory or not. Our current view is that the economy will revert to the lower average underlying growth rates that we've seen since the financial crisis, other things equal. But this will bring its own challenges. And frankly, there's a strong argument for not accepting this state of affairs as either inevitable or acceptable. And it's certainly not desirable in many ways. Stronger growth in potential supply, supported by stronger investment and productivity growth, will make the COVID recovery easier. The COVID shock, as we all know, has required an increase in public and business debt to smooth the impact. It has been a necessary and sensible response. But of course that cost has to be managed going forwards, and it will be easier to do that with a higher trend rate of growth, boosted by stronger investment. Now, although business investment recovered from a low base following the financial crisis, it was weak in the period prior to COVID. So the evidence points to the importance of raising productivity growth, supported by investment, in order to make it easier to handle the debt legacy of COVID and offer some protection against the risk that the decline in the labour supply during the pandemic proves to be more persistent. Now, there is an interesting issue of whether such a change is in fact already underway as part of the immediate response to COVID. Let me give you one example. Online retailing is an example of a sector where the impact has included higher productivity and investment to support a more digital service, and it has grown rapidly. But it's too soon to tell whether, of course, these changes that we've seen in the last year or so will persist and further expand. But I think it's fair to say that more investment to support growth will be needed, and that's why the Bank of England, the Treasury, and the FCA have emphasised working with the financial sector to ensure the supply of productive finance to support investment is available, work that's being led by John Glenn, who's here today, and it is very important work. So let me conclude with a reflection on monetary policy. The economy is bouncing back rapidly. With that has come a rise in inflation, and we expect that rise to continue in the near term as we go through the rest of this year, such that consumer price inflation is expected to pick up further above the target, owing primarily to developments in energy and other commodity prices. I've set out the reasons why we expect this rise in inflation to be a temporary feature of the bounce back. It's important not to overreact to temporarily strong growth and inflation to ensure that the recovery is not undermined by a premature tightening in monetary conditions. But it's also important that we watch the outlook for inflation very carefully, which of course we do at all times. particularly for signs of more persistent pressure and for a move of medium-term inflation expectations to a higher level. And if we see those signs, we are prepared to respond with the tools of monetary policy. Over the last 16 months, we've used monetary policy decisively to respond to an unprecedented crisis, which has been disinflationary. Now, we were able to do this and act in this way because the framework of monetary policy and the record of its use are robust. Having this credibility gives us the scope to act in a crisis. History, I'm afraid, has many examples of ineffective policy actions by weak institutions, and they don't tend to end well. Our credibility and institutional resilience have been hard won. Next year marks the 25th anniversary of the Monetary Policy Committee and the adoption of the objective of price stability. Memories of the instability of the previous approaches may be fading with the passage of time, but I can assure you, Lord Mayor, that our focus will remain firmly on taking the actions that are required to maintain price stability over time. Thank you.
Thank you, Governor. Now I am very pleased to introduce the Chancellor of the Exchequer, the Right Honourable Rishi Sunak, MP.
Lord Mayor, Governor, ladies and gentlemen, it is a privilege to finally address you here at the Mansion House. I want to speak today about the future of financial services in this country and around the world. And given my subject, I am delighted to see so many young leaders here today. I know that your talent, energy, and imagination matter far more for this industry's success than any government policy. And we need this industry to succeed. You contribute £76 billion in tax each year, enough to pay for our entire police force and our entire state school system. You employ 2.3 million people, with 2/3 of those jobs outside of London, in places like Glasgow, Belfast, Bournemouth, and Leeds. And you've been a lifeline through the pandemic, providing millions of mortgage holidays, billions of pounds of business loans, and with frontline staff keeping thousands of branches open in the most difficult of circumstances. And financial services don't just generate prosperity here at home. They give us the economic power to project our values on the global stage. But in recent decades, financial services has become emblematic of a broader loss of faith in internationalism. In the past, it was taken as a given that international cooperation created a fairer and more just world. Support for that view has fragmented. Now, international cooperation too often seems to be just warm words. The benefits of being a global services economy are perceived to flow too narrowly. This is not irreversible. International cooperation should move and inspire people. The benefits it brings should be seen everywhere, and we should be proud that people around the world look to this country for leadership. Those of us who believe in international collaboration must do more to explain why it matters and the benefits it brings. To do that, we must first be transparent about the principles we use to guide us in our economic diplomacy. Second, we must be clear about how we apply those principles in our economic relationships with other countries and jurisdictions. And third, we need a plan for our most global industry, financial services, which sharpens our competitive advantage while acting in the interests of our citizens and communities. Back in March, the Prime Minister and Foreign Secretary published the conclusions of our integrated review, the most far-reaching foreign policy document a British government has published in decades. As we apply the review's conclusions to our economic and financial diplomacy, we will follow 5 principles. First, openness. We believe in open societies and free economies founded on democratic values. Only the creativity, ingenuity, and dynamism of free individuals can deliver lasting economic growth. Second, a rules-based international order. Openness and freedom must be protected by rules that are followed and enforced. We will pursue high-quality regulation because it leads to better markets and will strongly resist its politicization. Third, a sovereign approach. The UK will use our new freedoms to follow a distinctive approach founded on UK law, protected by independent UK regulators designed to strengthen UK markets. Fourth, multilateral engagement. We will engage and lead in multilateral settings, helping to solve the world's most challenging problems. And finally, we will pursue real change. Engagement alone isn't enough. Our international actions must make a tangible difference to people's lives. So what do those principles mean in practice? As we pursue an independent path outside the European Union, they will guide our economic relationships with other countries and jurisdictions. That begins with our closest neighbours in Europe. The UK has an abiding interest in a prosperous and productive Europe. We have deep shared values and a long history of cooperation, and we will strengthen those ties. At the same time, as I said in Parliament in November, our ambition has been to reach a comprehensive set of mutual decisions on financial services equivalence. That has not happened. Now we are moving forward, continuing to cooperate on questions of global finance, but each as a sovereign jurisdiction with our own priorities. We now have the freedom to do things differently and better, and we intend to use it fully. But I can equally reassure you, the EU will never have cause to deny the UK access because of poor regulatory standards. Take firms like clearinghouses, which are fundamental to the open, free markets that we advocate. Now, the UK already has one of the world's most robust regulatory regimes for central counterparties. And our plan is not to weaken, but strengthen that regime, because we believe in high-quality regulation. It is also entirely within international norms for like-minded jurisdictions to use each other's market infrastructure. So I see no reason of substance why the UK cannot or should not continue to provide clearing services for countries in the EU and around the world. Our principles and values will also underpin our relationship with the United States, our most important bilateral partner. The US is already our biggest market, with the UK exporting $28 billion of financial services every year. Our ambition is to deepen regulatory cooperation even further with our closest ally. And our principles will also guide our relationship with China. Too often, the debate on China lacks nuance. Some people on both sides argue either that we should sever all ties or focus solely on commercial opportunities at the expense of our values. Neither position adequately reflects the reality of our relationship with a vast, complex country with a long history. The truth is, China is both one of the most important economies in the world and a state with fundamentally different values to ours. We need a mature and balanced relationship. That means being eyes wide open about their increasing international influence and continuing to take a principled stand on issues we judge to contravene our values. After all, principles only matter if they extend beyond our convenience. But it also means recognizing the links between our people and businesses, cooperating on global issues like health, aging, climate, and biodiversity, and realizing the potential of a fast-growing financial services market with total assets worth £40 trillion as we harness the UK's financial innovation and expertise to meet those global challenges. And it is precisely because we are taking steps to protect our domestic economic resilience that we can pursue with confidence an economic relationship with China in a safe, mutually beneficial way without compromising our values or security. Now, just as our principles inform our economic relationships with the EU, US, and China, so they must apply to our most global industry, financial services. Over the next few years, we will implement a sweeping set of reforms, sharpening our competitive advantage in financial services, continuing to deliver for our communities and citizens, and working internationally in fora like the G7, the G20, the Financial Stability Board, to set higher global standards. I'm publishing today a document setting out our vision in detail across 4 themes. First, we must be open, seeking closer links with advanced and emerging financial centers around the world. Just yesterday, I signed an ambitious financial services partnership with Singapore, a practical demonstration of our commitment to the Indo-Pacific tilt. We're negotiating a groundbreaking deal with Switzerland, the most ambitious financial services agreement ever attempted. And I will always defend the global norms of open markets, such as delegation of portfolio management. Second, we will boost our competitiveness across both regulation and tax. To do that, we're consulting on reforms to the regulation of wholesale capital markets, implementing the recommendations in Lord Hill's listings review, including a fundamental review of our prospectus regime, and reforming the prudential regulation of the insurance sector, all while taking targeted action to reform high-skill visas to attract the best global talent. And I announced at budget that we'd review the bank surcharge. Our ongoing conversations have only reinforced my view that the combined tax rate on UK banking profits should not increase significantly from its current level. I intend to conclude the review as planned later this year. Now, just as the UK pioneered paper banknotes in the 17th century, the first regulated stock exchange in the 19th, and the first ATM in the 20th, the third part of our vision puts the UK at the forefront of technology and innovation in the 21st century. To promote the adoption of cutting-edge technologies, we're taking forward the recommendations in Ron Khalifa's review of UK fintech, exploring the case for a central bank digital currency with the Bank of England, consulting on pioneering reforms to support the safe adoption of crypto assets and stablecoin, and watching closely the key debates in finance and tech, like the opportunities of distributed ledger technology in capital markets. But while I believe in the power of new technology, we also need to manage its impact on our economy and society. We've led the way on an international agreement on digital taxation at the G7, a perfect example of our principles of economic diplomacy in action, which I will continue to push for at the G20 next week. And we're protecting access to cash, consulting on new laws to make sure people only need to travel a reasonable distance to pay in or take out cash. And we will reaffirm the UK's position as the best place in the world for green finance, the final part of our vision. We're giving the public the opportunity to invest in the government's green initiatives through NS&I's world-first green savings bond. We're issuing the UK's debut sovereign green bond in September, with a framework published yesterday committing us to the most ambitious approach of any major sovereign. We're launching new requirements for businesses and financial products to disclose sustainability information and creating a global market for high-quality, voluntary carbon offsets with thanks to Dame Clara Furser's leadership. And on the international stage, as we push for global action ahead of COP26, we've persuaded all G7 economies to move towards making climate disclosures mandatory, a clear demonstration of international cooperation delivering tangible solutions to pressing global problems. So, more open, more competitive, more technologically advanced, and more sustainable, that is our vision for financial services. The roadmap we are publishing today sets out a detailed plan for the next few years, and I look forward to delivering it together. In conclusion, Lord Mayor, as the baton passes to a new generation of leaders in finance, many of whom are in this room, I feel optimistic about our future. Ambitious at home, confident internationally, with a plan to make this country the world's most exciting financial services hub for decades to come, creating prosperity at home and projecting our values abroad. And as we lead through action, not rhetoric, guided by our principles, we will show that economic cooperation can help to make a fairer and more just world. Thank you.
Thank you, Chancellor and Governor, for joining us today and sharing your insights in what were two excellent speeches. Governor, we welcome the launch of the Bank of England's Plain Numbers initiative for simplifying the way financial information is presented and making it more accessible to the whole community. Chancellor, thank you for your roadmap for financial and professional services. We look forward to navigating it and making sure that the city is always sustainable, innovative, and open. I was especially pleased to hear the details about the UK's sovereign green bond and the green savings bond, a real boost to the UK. Now it won't only be the US where the colour of money is green. Thank you very much, everyone who has joined us in person and online, and to everyone who has made today's event possible. And we hope to see you again soon. Thank you.